Assalamu alaikum everyone. Today's video is about, it's a partnership question, and it's for the first time that I'm posting something from partnerships. And this question is basically from May-June 2023, paper 22. It's question number 4. It says Akila and Darius are in partnership. The partnership agreement provides for the following. So all partnership questions will have these details that you need to use for appropriation account. So they're saying here, interest on capital 3% per annum, interest on drawings 5%, a salary to Akila of $9,500 per annum, residual profits and losses to be shared 60% to Akila and 40% to Darius. Then they're saying the partners provided the following balances: capital accounts, they've given you capital account balances, and then they have given you current account balances. And then they have given you two balances for drawings, 19,400 for Akila, Darius 16,320. Then they have given you the profit for the year, that is 42,304. That tells me that they have calculated profit. So income statement is not what they'll ask you in the questions. Then they're saying in part A, prepare the appropriation account on the opposite page for Akila and Darius for the year ended 30th April 2023. Appropriation account is quite easy because it is on a specific format. So when you start an appropriation account, you start with the first value here will be profit for the year. So profit for the year here is, in this question, is 42,304. The last statement tells me that my profit for the year is 42,304. Then you'll write add interest on drawings. So firstly, you charge interest on drawings on partners' drawings. So this is basically to discourage partners from withdrawing money from the partnership business, and that is why we charge interest on their drawings. And here for Akila, I'll have to calculate it. So Akila's drawings is 19,400, and 5% of 19,400 basically is 19,400 into 5%. You get here 970. And then you calculate Darius's interest on drawings. His drawings is 16,320, and again 5% on 16,320 will be 816. When you add these two, 970 plus 816 gives us 1786. This is the total interest on drawings. So what's the point of actually adding interest on drawings? It's because partners' capital is being reduced because partners took out money from the business. So whenever they take out money from the business, drawings also reduces partners' capital. Similarly, interest on drawings is charged to partners, and therefore the partners' capital is again reduced because of interest on drawings, and this is basically added back to partnership profit. And when you add 42,304 with 1786, you get 44,090, and then you need to subtract certain things here. So we'll subtract interest on capital, we'll subtract salary that is given to Akila. So why are we subtracting these two? Because these are basically, interest on drawings is taken from the partners. So we are basically charging them and taking that bit from their capital and adding back to our partnership profit. Similarly, interest on capital is basically given to partners because they have invested the money in the business. They are basically rewarded for investing in the business. That is interest on capital, and it's basically a reward on investment. So if they had invested somewhere else, they would have gotten interest on that investment. So in this case also, because they have invested in the partnership, we are basically giving them interest on capital from the profits of the partnership. So we'll write here less interest on capital, and then we need to calculate for Akila and for Darius. So I'll write here Akila. For Akila, the capital here is 90,000, and the interest on capital here is 3% per annum. So I'll write here 3% of 90,000 gives me 2,700. Similarly, for Darius, I'll calculate 3% of what is Darius's investment. Darius's investment is 65,000. So 3% of 65,000 gives me 1950. And then I need to subtract the salary. So I write here less salary, and salary is given to Akila only. So I'll write here Akila. I'll write here 9500 because salary that was given in the question was 9500. When I add these three, I get a value of 14150, which I will subtract from my from this value, that is the profit plus interest on drawings. So 44090 minus 14150 gives me 29940. This is the residual profit. This is called residual profit after all the appropriations. When you add interest on drawings, less interest on capital, and less subtract the salary, the profit that is remaining is the residual profit, which will be divided in the ratio, in the profit sharing ratio, which is here 60% for Akila and 40% to Darius. So 60-40 is the ratio. So we'll just calculate their profit shares. So I'll write here profit shares. I'll first write Akila. And I'll write here 60% of 29,940. And this comes out to be 17,964. Then again, I write here Darius, and I write here 40% of 29,940. And that comes out to be 11,976. So this is my, basically my, after the profit appropriations, both of these turn out to be 29,940. So 29,940 is divided in 60% to Akila and 40% to Darius. So now in the next part, they're asking you to make a current account for Akila. So what is the point of current account? So in partnerships, whatever the changes are there in the capital. So in case of a sole trader, what happens is that whatever profit sole trader is earning during the year, so the profit for the year is basically added to the sole trader's capital. So whenever it's a sole trader, we are just making the capital account. Whenever we're making a capital account for a sole trader, we add the profit for the year. On the credit side of the capital account, we just write profit for the year. On the debit side of the capital account, we write drawings, and then we calculate capital at end. So that is how it works for sole trader. But for partnerships, we have capital accounts that are kept fixed. So any permanent increase in capital, for example, in this case, let's say Akila brings in more capital, that will be put into the capital account. But other than that, any profit that is given to partners, interest on capital that is given to partners, salary that is given to partners, drawings that the partners take out from the business, interest on drawings that is charged to the partners because of their drawings, is basically written in their current account, not in their capital account. So capital account stays fixed. All the other things that are changes that are happening to capital, like the profit that the partners are receiving, those are put into the current account of the partner. So here they are asking you to make just one current account, that is for Akila. They could have actually asked you to make two current accounts. That is also possible. For both of them in one account only, that is also possible. There are lots of questions which have that kind of requirement. But here, you know what information, whatever information is for Akila. So interest on drawings for Akila is 970. Akila's interest on capital is 2700. Akila's profit share is 17,964. And Akila's salary is 9,500. That is all important. Akila's current account balance is a debit balance, 2,600. So you'll start with the debit balance in the current account. So I'll write here 1st May 2022. Balance brought down. So this is for the year ended 30th April 2023, but the current account will start with the balance at the start of the year. So the start of the year here is 1st May 2022. I'll write here balance brought down 2,600, and because it was debit, that is why I'm writing it on the debit side. So here I need to whatever we are giving to the partners, so this account increases on the credit side, decreases on the debit side. Whatever is given to the partners during the year, that is written on the credit side. So interest on capital 2,700 is given to the partners. Salary 9,500. Again, profit shares. So profit share for Akila was 17,964. Here I'll write interest on drawings. Akila's interest on drawings was 970. Yes, it was 970. interest on drawings for Akila's drawings. And then Akila's drawings is 19,400, which will be recorded on the debit side of current account because drawings always decreases capital. So I'll write here drawings. I'll write here 19,400. So this is all that is happening in Akila's current account, and now we need to calculate the balance carried down for Akila's current account. So basically, to calculate Akila's current account balance, debit side total is 22,970 and credit side total is 30,164. So that is the totals. That are the totals. So 30,164 minus 22,970 gives me a balance carried down here. So balance carried down comes out to be 7,194. This is going to be 30th April 2023. This account will total at 30,164, 30,164 on both sides. This balance carried down will become your balance brought down. I'll write here balance brought down. I'll write here 30th April 2023. This balance carried down will become balance brought down. This will be 7,194. This will be 1st May 2023. And these basically interest on capital, salary and profit share was calculated on 30th April when we actually made the appropriation account. So I write here 30th April 2023 is the date for all these, and here also 30th April 2023. So that's it for this current account. In the next part, they're saying calculate the balance on Akila's current account at 30th April if he had been due $1,000 loan interest from the partnership. So if Akila was given a loan interest from the partnership, in that case, Akila must have given a loan to the partnership. So when a partner gives the loan to the partnership, the interest is basically put in their current account. So whenever a partner is given, like if the partner is not paid the interest, right? So whenever partner gives a loan to the partnership, it's like the partner lending money to the partnership. And in that case, when the partnership does not pay the interest to the partner, if the interest is due, so it's like owing interest. Although we have incurred the interest, the expenses has been incurred, but the partnership hasn't paid to the partner. In that case, partner's current account must be credited, so that that interest is basically put into partner's current account, and basically capital is increasing by the interest amount when it's due, when they haven't paid it. So if the balance for Akila's account is 7,194, we'll just add $1,000 interest, because this will increase Akila's current account balance, but it will also decrease the partnership profit. So this 42,304 is not going to be 42,304. Profit for the year will be 41,304, because this interest $1,000 must have been subtracted from the income statement, because interest is an expense and they have incurred the expense. So you have to subtract that. So 41,304 will be the profit. So that means residual profit will also be 28,940. This will also reduce by 1,000. So the reduction will come on the profit share as well. So that interest, that is 1,000 given to Akila, this reduction comes on profit for a profit like the residual profit or the profit shares that are given to the partners. So 28,940, if we divide this by into 60 and 40, so 60% of 28,940 will come out to be 17,364. So 17,364 is 60% of 28,940. So that means the profit share is being reduced by 600. So that means the current account balance will 1,000 will be the increment in the current account balance, because the current account will be credited because of it. And then the current account will be credited with this profit, that is 17,364, not 17,964. So that means Akila will be given a profit reduction of 600. So this will be his new balance. 7194 plus 1000 minus 600 will be the new current account balance. And this will come out to be 7594. So this will be the new current account balance of Akila. Then they are saying Akila and Darius's partnership agreement provided for salary, interest on capital, interest on drawings, and profit share. State two other items which are usually included in a partnership agreement. So that can be the amounts that are invested by the owners. One other thing that can be included in the partnership agreement will be the interest that is given to a loan that is given by a partner. So interest on loan given to the business by any of the partners. This particular part of it's basically theory of partnership, that what all things are included in a partnership agreement. So that should be actually as part of your exam preparation, you should know the theory, like advantages and disadvantages of being a partnership business. And what all includes in the partnership agreement is also part of the exam syllabus. Okay, in the last part they are saying Akila and Darius are considering forming a limited company. They would be the only two shareholders in the company, so they are saying they want to become a limited company. So what are the advantages and disadvantages of Akila and Darius forming a limited company? So limited companies are basically highly regulated companies. There are lots of costs that are involved in setting up a limited company. So these are the disadvantages. So there are costs involved in setting up. So setting up a limited company would be very costly. The second thing here could be that they are highly regulated. So they are limited companies and they are registered. So they are highly regulated, and basically there are lots of rules that they need to follow. They need to get their annual reports checked by an auditor. So an auditor is an external party. It's not someone within the business. It's someone outside the business who checks their annual reports. So they are highly regulated. Plus, they need to issue their annual accounts for inspection for the public. So issue their annual accounts, that is annual reports. Annual reports include income statement, statement of financial position, the ratios of the business. All of these things are included in the annual reports. So their annual reports include everything. All the information of the business needs to be available for inspection for the public. Okay, the advantages would be that limited companies can raise a lot of finance. So if these are just two Akila and Darius, if they are forming the limited company, but once they are limited companies, they can invite more shareholders to invest in their business. So can raise a lot of finance, and this finance can be used for expansion, for all other things, and expanding the business, growing more. Also, the advantage would be that they have limited liability. So in partnerships, they don't have limited liability. If the partnership goes bankrupt, they need to sell off their personal possessions in order to pay off the partnership liabilities. But in case of limited companies, they don't need to sell their personal possessions. They can just they would lose only that amount that they have invested. So their personal possessions will not be at risk. So limited liability is the advantage of forming a limited company from a partnership. So there can be other advantages as well. Another advantage would be that partnerships don't continue to exist if one of the partners die. But in case of limited companies continue to exist even if one of the shareholders die. So the continuity of existence is also an advantage of a limited company, not a partnership. So that's it for this question. You guys need to give a recommendation also to Akila and Darius. So you can give a recommendation, yes, they should form a limited company because they can raise more funds and grow more as a business. Or whatever your opinion is, if you think that they should not go for this decision, so it's your opinion, you can give it. And that's it for this question. Thank you so much for watching.